Most retirees should not do a Roth conversion, and the financial internet is screaming the opposite, telling everyone over 60 to convert, convert, convert as if it were free money. It is not. A conversion is a voluntary tax bill you hand the IRS today in exchange for a smaller one later, and if you get the timing wrong, you can light tens of thousands of dollars on fire. You can push your Medicare premium up by almost $2,000 a year per spouse. You can drag more of your Social Security into the taxable column. You can even convert at a market top and pay tax on dollars that then fall right back down. In the next few minutes, you will learn the narrow profile of the retiree who actually benefits, the hidden traps that quietly destroy a sloppy conversion, the worked math of where to stop, and the single most counterintuitive rule in this whole subject: the best time to convert is when the market is down, not up. Start with what the law actually rewards, because it created a quiet planning window most 60-somethings walk right past. The day you stop working, your income usually drops, but required minimum distributions, the forced withdrawals from your traditional accounts, do not begin until age 73 for most people retiring now, and age 75 if you were born in 1960 or later. Social Security can also be delayed all the way to age 70, so there is a stretch, often the years from the mid-60s into the early 70s, where your taxable income dips into a valley before the IRS forces it back up. That valley is the window. Inside it, you may be able to move money out of your traditional IRA and pay tax at a relatively low rate, on purpose, before the forced withdrawals start taxing it for you at a rate you no longer control. And one more fact worth holding on to: households age 50 and older hold more wealth than every younger generation combined, and the bulk of it sits in exactly these pre-tax retirement and brokerage accounts. So this is not a niche problem. It is the central tax problem of an entire generation. Here is why that forced withdrawal matters so much. At age 73, the IRS makes you start emptying your traditional accounts whether you need the money or not. The first year's required withdrawal is about 3.8% of the balance. On a $1 million traditional IRA, that is roughly $37,700 you are forced to pull out and pay tax on in a single year. And it does not stay there. The percentage climbs past 4% in your mid-70s and keeps rising every single year after that, because the IRS divides your balance by a shrinking life expectancy number. So the bill grows just as your other income, Social Security, maybe a pension, is also at its peak. A Roth IRA, by contrast, has no required minimum distributions during your lifetime. None. So every dollar you convert today is a dollar that will never be force-marched out of a traditional account at 73, 75, or 85 and never stack on top of your Social Security in your 80s. Now the first trap, and it is the one that wrecks more conversions than any other, the Medicare IRMAA cliff. Your Medicare Part B premium is income tested. In 2026, a married couple with income up to $218,000 pays the standard premium of about $203 a month per person. But cross that line by even $1 and your premium jumps by about $81 a month for each spouse. That is roughly $160 a month more for the couple, almost $2,000 a year, triggered by a single dollar of income. And it does not stop at Part B. Your Part D prescription premium climbs at the very same income line. It is not a gradual phase-in. It is a cliff. And here's the cruel part. It is based on your modified adjusted gross income, which is figured before your standard or itemized deductions, so you cannot deduct your way back under the line. Worse, it runs on a 2-year lookback. Your 2026 premium is set by your 2024 income, so an oversized conversion can raise your Medicare bill 2 full years after you forgot you did it. The second trap is the tax cascade, the way one oversized withdrawal sets off several penalties at once. Pull too much out, and the same dollars can push you into a higher bracket, drag more of your Social Security into taxation, up to 85% of your benefit can become taxable, raise the rate on your capital gains, and separately trip the 3.8% net investment income tax on your investment gains. Those are separate machines, all triggered by the same income, all firing together. This is why the move is never convert a big round number. A dollar that looks like it is taxed at 22% can actually cost you far more once it pulls Social Security and Medicare along with it. People look at the bracket table, see 22%, and assume that is the price. The real price on that next dollar can be 30, 40, even 50 cents once everything stacks. So who is the rare retiree this actually fits? The profile is narrow, and most people do not match it. First, roughly 70% or more of your total wealth sits in pre-tax accounts, traditional IRAs and 401ks. So you have a genuine future tax problem brewing. Second, you are currently in that income valley, under roughly $100,000 a year, with real room before the next bracket. And third, this is the one people forget, you want to leave a meaningful inheritance to heirs who are themselves likely to be high earners. If all three are true, conversion math can work powerfully in your favor. If they are not, If most of your money is already in a brokerage account or a Roth, or if your income is already high, or if you plan to spend the money yourself, then you are very likely prepaying a tax you did not need to pay. That is the contrarian truth. For every retiree who should convert, there are several who should leave the account alone. That third point deserves its own minute, because the rules for your heirs changed, and most people have not caught up. When a non-spouse heir, usually an adult child, inherits a traditional IRA, they generally must empty the entire account within 10 years, and every dollar comes out as ordinary income taxed at their rate. In many cases, they also have to take a required withdrawal in each of those years, not just clear it out at the end. If your daughter inherits that account in her peak earning years, those forced withdrawals stack on top of her salary at her highest bracket. A reasonable planning assumption for a high-income heir a decade out is a 32% bracket. Now compare that to a Roth. Qualified Roth dollars pass to your heirs free of federal income tax. The same 10-year clock still applies, but they owe no income tax when they empty it. So converting in your low-income valley, at perhaps a 22% rate, can be far cheaper than leaving a 32% bill for a child at her earnings peak. One important exception you should know: a surviving spouse, a minor child, a disabled or chronically ill heir, or someone less than 10 years younger than you is not bound by that 10-year rule and has more flexibility. Now the math of where to stop, narrated the way you would build it on a worksheet. Picture a married couple, both 66, both retired, living on Social Security and a small pension. For 2026, their standard deduction is $32,200 plus an extra $1,650 for each spouse who is 65 or older. Because both of them are over 65, they add both bumps, shielding about $35,500 before a single dollar is taxed. Above that, they climb the brackets. The 22% bracket for that couple runs all the way up to about $211,000 of taxable income. Above that, they enter the 24% bracket, which runs to about $403,000. Then comes the jump that matters, from 24% straight to 32%. That is an 8-point leap in a single step. So the seasoned move is to fill the 22 and 24% brackets and stop cold before 32, while also staying under your IRMAA line at $218,000. You convert to fill a bracket, not to hit a round dollar amount. Walk that worksheet one more step, because the order of the numbers is everything. Say this couple's taxable income before any conversion is about $90,000. The top of their 22% bracket is about $211,000. Subtract $90,000 from $211,000 and you get roughly $121,000 of room inside the 22% bracket this year. That does not mean they should convert all of it. The IRMAA cliff at $218,000 and the Social Security stacking may pull the ceiling lower, but it tells them the shape of the opportunity, a 6-figure bracket of room available this year, that simply evaporates if they wait until age 73 and let the required withdrawals fill it for them instead. Which brings us to the single most counterintuitive rule in this entire subject. The best time to convert is when the market is down, not when it is up. Here is why. When you convert, you pay tax on the value of the shares you move. Convert $100,000 of stock after a 20% drop, and you pay tax on the lower figure. But the same number of shares moves into the Roth, and any recovery happens inside that account, federally tax-free, for as long as you hold it. Convert at an all-time high, and you are paying tax on inflated dollars that may simply fall back down, leaving you to have paid tax on value that no longer exists. Most people do the exact opposite. They feel rich at the top and convert into strength. They feel scared at the bottom and freeze. The disciplined move is to have your bracket map ready in advance so that when the market hands you a downturn, you already know exactly how much room you have to convert into it. So here is your decision map by where you actually stand. If you have under about $400,000 saved, this is probably not your problem. Your future required withdrawals are unlikely to push you anywhere painful, and a conversion may just hand the IRS money early for no reason. If you are between roughly $500,000 and $1.5 million, mostly in pre-tax accounts, you are likely the kind of retiree who benefits most from mapping this out carefully, bracket by bracket, before December 31st, because the window is real, but the cliffs are everywhere. And if you are above $2 million, the air math and the required withdrawal tax bomb gets serious enough that doing nothing is itself an expensive decision. Remember, this is a multi-year project, not a one-time move. You revisit it every fall, look at your actual income for the year, and convert only up to your target bracket and below your IRMAA line, usually spread over 5 to 10 years. Doing it all in 1 year is exactly what trips every cliff at once. This is educational only, not personalized financial, tax, or investment advice. Your numbers are your own, so run them with a qualified professional before you convert a single dollar. And if you want a free analysis of whether a conversion window actually exists in your plan, go to GaryLifeIndex.com/Roth-conversion.